When we left off last week, we were in the middle of the transfer pricing section. And we had gotten through what I think I referred to as, let's say, basic concepts. So now we're going to talk a little bit about transfer pricing methods. We're not going to talk very much about it because if we talked in any amount of detail, I think we would take far too much time. And this is something that I certainly would like you to take a look at personally in terms of just seeing in brief what these are as they're described in the regulations. Now, one of the aspects of transfer pricing is which method should you use? A few years ago, before the current regulations were put into place, there was a priority rule. In other words, you had to use a comparable, uncontrolled price if you could find one. You had to. If you couldn't, then you went to the next method, which was called the resale method. If you couldn't use that, then you had to go to a third method, which was cost plus. And if you couldn't use that, then you had to use your imagination and creativity and come up with something that made sense for your circumstances. Now it is no longer that way. We have a number of additional methods in addition to those three, and we have a principle that says there is no priority. You analyze your situation and come up with the best method that fits your situation, the one that will give you the economically most correct price. So this is the basic concept, and there's quite a bit of detail in terms of examples of this that you'll find in the regulations. So if this is an area you want to get into in significant detail, those would be something to read. That's in the -8 regulation. Again, from the standpoint of not going into too much detail, what I would like to do is just, in a sense, point out how different methods are allowed, so to speak, for different kinds of income. Now, of course, it makes sense economically that certain methods are allowed for certain types of income because, for example, you don't have normally a resale in the context of pricing a service. So later when we see a slide that says the services, we'll see a different listing of methods. Now, you'll notice that pretty much for every type, as we go through the slides, you'll find something regarding controllable, uncontrolled price, or as Ben was saying with regard to intangibles, comparable, uncontrolled transaction method, which he abbreviated as CUT, C-U-T. So you often hear, if you get into transfer pricing, the abbreviation CUP method for the method as it applies to transfers of tangible personal property. Now, just to mention a little something about this particular area where we're talking about primarily sales of inventory or sales of fixed assets that are not inventory. Any transfer of any asset can be covered by these by these methods. And your comparable uncontrolled price method, again, economically, can you find another transaction where the same product that is sufficiently comparable to your product transaction, your controlled sale? Can you find an uncontrolled one somewhere that's close enough where you can say, okay, I should use the same price? Or where it's close, but there's identifiable differences that you can come up with some quantification for each difference, so that again you can, by interpolation, come up with a price for your controlled transaction. That's essentially what comparable uncontrolled means. And you will remember from last week where we talked quite a bit about what comparability means. We talked about functions, we talked about risks, we talked about contract terms, economics, those types of things. And as I think we tried to point out last time, while this is, an area where we deal with numbers, and you think, gee, this should be relatively black and white, and coming up with things, it's an objective process. No, it really isn't. It's very, very subjective as to what is or what is not comparable. Yes?
I had a question about that, because we're in a time where there's not really something comparable. I mean, economically, how do we look at how the economy rises and falls? I mean, we have to go back to, I guess, the 80s? Or do not make that retroactive perspective?
Well, let's say that you have a situation where, okay, you have a transaction today, and let's assume all other things are the same in terms of the product being sold, the conditions that it's being sold under, and so on, except that it was sold 30 years earlier. Now, you have to make this subjective judgment. Is the time a factor? Can you adjust for inflation that has occurred between the two periods? Were economic conditions sufficiently similar or not similar back then to allow you to consider this comparable? I would say it would be a very unusual situation where 30 years has elapsed and you conclude that it really is comparable. But again, that could be, you might have a situation where that in fact happens. Yes?
Just to kind of taking a step back for a second, in terms of actual practice, I mean, if you're an attorney, it seems like all you would do is say, we have a transfer pricing issue, call in the economist. Like, is that right? I mean, is that...
Actually, that is not far off. That is not far off.
And then...
Absolutely.
And then just really quickly, is it also the job of attorneys then to evaluate to some extent that the economists have satisfied the elements of what the regulations set forth? I mean, is that also a piece of the work that they would do? Or?
Well, I would say it this way, that we'll get into this a bit more in some later slides, but I think the point is that in your place as an attorney involved on your client, that number one, you have to be alert to economic situations where the pricing might innately have a problem and create risks for your client that cause you to say, hey, we do need to call in the economists to do a study on this area because it's high risk. Now, once the economists are brought in, yes, you're part of the team in a sense, which makes sure that what they're looking at are the right things, because if you're doing your job right, you know your client's business. And you should be, in a sense, helping the economist plan what they're going to do and make sure that they've done it and that they've applied the law correctly. Generally, the economists who work in this area are specialized in this area, and this is all they do. Whereas this just isn't a sidelight for them, where they occasionally do a transfer pricing project. So you're part of the team, but more importantly, and again, I'll get into this a little more on a later slide, you're the one who's out there, and you have to, in a sense, look for where the risk areas are and attempt to help your client manage that risk. Now, in real life, the comparable uncontrolled price method, although it might be termed the gold standard of pricing, isn't actually used very often because it's so seldom that there really is an exact comparable. So what happens? Well, some other method ends up getting used. Now, if we have a situation where there's, let's say, a manufacturer and a distributor in the group, then one approach, in a sense, is to look at that distributor and use what's called the resale method, which lends itself to distribution type situations where a product is purchased and resold. And why is that a relatively practical method? Because there's a lot of databases which show for various distributors in different industries what margins they're making. So it's possible to find not necessarily an exact comparable product, but you can learn roughly what profitability, what operating income a distributor has in a particular industry. And that can create a range. In other words, by looking at 5 or 10 or 20 different distributors, you end up getting a range of margins which you then apply to your controlled situation. The cost plus, on the other hand, does not lend itself to a distributor situation. Cost plus implies, well, you're performing a service for me, and I'm giving you all you need in terms of knowledge. I'm the one taking real business risk on this thing. You're just performing a service to my specifications. So cost plus will very often be used there. And contract manufacturing is the most typical example of that. Comparable profits method, there maybe you have 2 or 3 or more companies that are all related, and they're all contributing to some sort of a transaction. Let's, for simplicity, say there's two companies. You look at each company and you say which one has the more, let's say, mundane business. Which is the one that has more routine activities? Because routine activities, in a sense, can be valued. If activities are not routine, if they're special for some reason or they involve important intangibles, then that, of course, makes it very hard to value. So if you can find one company which, in a sense, is only performing routine functions, mundane functions, you can come up with probably a pretty good value for what those mundane functions are, and then use that for this, what's referred to as the tested party, and then once you have that number, you know what the number is for the other related party. And then the last one, profit, or the second to the last one, profit split method, attempts to, again, calculate for the various transactions that are being looked at a combined profit, and then come up with some logical method which takes into account the relative functions and values and assets and risks that each party is conducting. Try to come up with some sort of a split. Maybe, gee, the value this one has is 45%, and the value this one is bringing to the table is 55%, so we're going to split the profit on that basis. So those are, in a nutshell, the principal methods. The unspecified method is, well, gee, if you can find something that makes even more sense than any of these, and you can convince the IRS of it, use it. Now, notice the top part is transfer of tangible property. The bottom is use of tangible property. And the regulations there really only speak about a comparable uncontrolled rental. In a rental situation, I think it's probably a little bit easier to, in a sense, come up with some sort of logic, whether it's that you actually find another rental of the same property between unrelated parties, or you come up with what, in a sense, return on investment a lessor might have for property of that category. The next area, transfer of intangible property. Now, this is kind of interesting structurally because you're, of course, taught from other aspects that it's very important to know whether you have a sale of an intangible or whether you have a license of an intangible. It can make a big difference whether you have capital gain or ordinary income. It can make a big difference in terms of sourcing of income. But here, for transfer pricing purposes, they're lumped together, recognizing that whether all rights are transferred or whether it's only certain rights for a limited period, we're looking at the same question of value of an intangible. So the rules do not distinguish between sale and license. We have the same choices and the same application for both types of transactions. Now, note the bottom point about the commensurate with income concept. Congress, some years ago, was concerned, of course they're still concerned, but that's another issue, was concerned with the fact that if you sold an intangible, you had to come up with a price today for the date of transfer. And once that price was determined, that's the price you live with. And if it turns out that this intangible is, on the one hand, turns out to be really worthless in the future, the transferee really is not able to use it to gain any profit, well, that's the transferee's tough luck. On the other hand, of course, if, and this is what Congress was more concerned about, if this formula, for example, for a drug turned out to be the only cure for cancer, then the transferor would be recognizing, the value at that date of transfer, which doesn't reflect the fact that this becomes so important later because of events that happen later in terms of how the product is marketed, its efficacy, its all of these factors which come out later after the transfer. So Congress said there's something wrong with producing intangible property here in the United States, selling it for what's arguably an arm's length amount, but it turns out to be so extremely valuable, all that excess profit is earned overseas in the subsidiary that let's say the parent has sold the formula for this drug item to. So they said, even though you sell it today, even though you enter into a license agreement, which is arm's length today, there must be adjustments later if that property turns out to be so valuable that it really should have been sold at a higher price. It should have been licensed for a higher royalty percentage. So this is what the comparable, commensurate with income concept is. And later, when we talk about 367D, which was mentioned this morning about tax-free transfers of property, in this case specifically intangibles, that would otherwise be tax-free, but except for this 367D rule, we'll see that that also has a commensurate with income concept in it. So that, again, the U.S. transferor is made to recognize income that takes into account future events not known at the time of the transfer. So that concept, both 482 and 367, taking into account events after the transfer. Okay, there's quite a list of items for services. Probably the only one that really merits a word or two is the service cost method. And essentially what that's saying is that in the case of certain normal routine activities, the transfer price can be equal to the cost of the activities without any profit markup. And there's a as I recall, a revenue procedure which lists out many activities which arguably come within this. So, for example, if you're working within the in-house legal counsel, the in-house counsel section of a company, your costs, because of the work you're doing that benefits a subsidiary, for example, only your costs would need to be charged to that subsidiary. There doesn't need to be a markup on those costs, despite how valuable your advice might be. Does that make you feel bad, Jessica, that you're not being valued sufficiently?
So long as I get paid a lot, I'm sorry.
I see. Okay, very good. What are you laughing about? You don't think she's going to be worth that much? Okay, anyway, moving swiftly onward. Okay, loans and advances. There are, of course, a couple of methods. One which is, arm's length, determine what unrelated lenders and borrowers under the same conditions would charge in terms of interest. And as an alternative, if you're talking about US dollar loans or advances, there's specifically an applicable federal rate safe haven methodology. And every month, the IRS publishes in a revenue ruling the short-term, mid-term, long-term rates, AFR rates, for these types of transactions. Before we go on to the next section, any questions about the pricing methods as opposed to other aspects? Yes, Jessica.
So if you're doing a comparable pricing method, if you're comparing to a sale to not another controlled entity,
If you're looking at an uncontrolled transaction, yeah.
do you get to do a markdown for the synergies because your companies are related, or no?
Well, actually, you're getting to a very interesting aspect, which I think we can talk about in theory, but really isn't there in the regulations. And that is, if we look at, let's say, two unrelated companies, okay, they're going to negotiate and bargain and come to whatever the price is, and each one will make whatever it makes. But you take a multinational in today's environment that is manufacturing in maybe 5 different countries, several of which are in Asia and have very low labor rates, has R&D functions in the United States and maybe in some other locations as well, has sales and distribution and logistics functions at various places. In other words, a very integrated operation. In a sense, one of the things that adds to their bigness is the fact that they do have some economic economies of scale. There's some sort of intangible of just being large and having all these resources. And yes, if you add up all of the amounts that are earned in total, yeah, it might be more than just what the unrelated buyer and seller earned if you combine their operations. So, yeah, theoretically, there's a factor there. And except maybe in the profit split method, this doesn't get accounted for. So, yeah, it's a very interesting area that, in theory, there's some value, but it's really not taken into account.